The world's fifth largest gold producer, Harmony Gold Mining Company, reported a 67% drop in quarterly profit that fell short of market expectations as power rates and the costs of a troubled asset it recently bought took a bite from its earnings. Its headline earnings per share fell sharply to 30 cents in the 3 months to the end of June from 91 cents in the previous quarter.
Harmony, we've got a market cap of 42.5 billion using a HEPS of 223. We've got a price earnings of 47.2, dividend yield of 1.2. Paying a dividend, not a juicy one, but a dividend. Byron, let's come to you first because I was reading your blog post today and you had some numbers and I can't remember. You can tell me where they came from. But average cost cash costs in South Africa $922, rest of Africa $575, North America $543, Asia $475. Europe $523, Latin America $444. Harmony come in cash costs for the year at $1,009. Almost got to say we're wasting our time mining gold in this country.
Yeah, I'm not going to take credit for that particular blog post. That was my colleague Sasha's.
Okay.
But I did take a close look at it, and yes, South Africa was the worst on that list of that analysis, and obviously they had taken companies with bad previous, with high costs. So it might be slightly biased, but definitely. And I've been on this show a few times, and every time there seems to be a gold stock, in the mix. And I'm going to start feeling like a stuck record. Yeah, it's the same. It's the same thing. And I also had a look at Harmony's results from 10 years ago, and quarter on quarter they had a production of 500,000 ounces. And costs were 1/3 that they are now. Today we had production of what's around 330,000 ounces, and again costs up 300%. It's a terrible trend.
Okay, so you're the trader here, and over the past 10 years or so, Harmony is actually quite flat. Is this a stock that you would trade? Because we've seen Harmony enjoying gains because of the Papua New Guinea assets, and that's when we saw it ramping up quite nicely, and then subsequently plunging and down over 4% in today's session.
Yeah, I don't think it's the most exciting stock. I think if you own gold shares and you've seen what's happened to the gold price, especially last week, and then you look and you compare it to what's happening with your gold. Exactly. So not exciting at all at the moment, and I don't think they ever will be.
Well, that's going to be my question. Are they ever going to get exciting, or are we just really flogging this horse has bolted the stable and long since gone?
Yeah, I mean, if you look at it over 5 years, like we say, it's done absolutely nothing. And I forecast, possibility. I'm not like Byron, I'm not a gold bug that, think that it's going to $3,000 in those ridiculous numbers. But I don't think that, these guys are going to do fantastically well. And if it
went to $3,000, Harmony would probably go to $80.
It'd probably be exactly that.
Well, I'm sorry, but none of you here predicted that it would hit over $1,800 an ounce either. So who knows what could happen? Would it hitting its target of 2 million ounces a year by 2015 make it exciting for you, Byron?
There's not much that's going to make it exciting for me. I know they talk about the Papua New Guinea asset, and apparently, there's fantastic grades there, and I think there's 20% of their gold reserves are now in Papua New Guinea. But again, that's their only international diversification. We've spoken about goldfields before, and they have a much bigger and better mix. Just way too many assets in South Africa. I'm not positive on the gold on gold long term, so I wouldn't be excited ever.
Papua New Guinea, great asset, etc., but still 92% of production coming from South Africa. That number is going to start changing quite swiftly as Papua New Guinea starts coming on stream. It did just over 3 tons this year. It was just under 2,000 tons previously. So it's starting to ramp up there. But it's going to come to the point, if I'm an investor and the global person, perhaps more, who's got access to it, I can look at a South African Harmony where even if half of my production is in South Africa, which is deep, expensive, dangerous, massively rising costs, threats of nationalisation, I could go look at a gold mine that's got none of these issues. I'm going to choose the other gold mine almost every time.
And it's also remember that this is at a time when gold price is at an all-time high. This is when these companies should be blowing the lights out. I know in the previous quarter they had a big tax break, so that's why this quarter didn't look as good in comparison. But with gold trading at these prices, they should be doing a lot better. And we were talking earlier before the show at the PE at the moment is trading over 40. For a gold miner, I think that's
you want to see like Kumba with iron ore plus 150.
And
you want to see it shooting the lights
less than 10. And you can actually use iron ore.
And trading at all-time highs, etc.
Relative to the likes of Goldfields, because we know that Goldfields cash costs coming in at just below $900 an ounce, and you've got Harmony above $1,000 an ounce, according to Byron's colleague, right? Taking a look at also the future projects, because that's what most people are focusing on, that most of these South African gold mining companies are starting to really diversify out of South Africa, and that's where you see the cash costs plummeting quite significantly. Tell us your thoughts about that. Do you think that this is what's going to put these companies in better stead down the line?
Yeah, I mean, and obviously that you're going to have to see if that does come about. I mean, I know Newcrest Mining was actually pretty interested in buying their 50% stake in, I think it was their Papua New Guinea. So, you know, if they do sell that, then once again they're back to square one, where they've just got assets here in South Africa. So that's a little bit concerning. I think the whole gold trade is a bit of a crowded trade at the moment. So, you know, fair enough, you know, gold could possibly go higher, but, you know, I think if you saw it recently, back down about $60 from its high last week. So, you know, I think there's too many people, including my hairdresser, who thinks gold's going up. So I don't like
Calling your hairdresser, now we're in trouble territory.
I hope she's not watching.
Okay, fantastic. I think, yeah, hot or not for you?
No, I think if you are bullish on the gold price, I'd maybe look at the gold ETF opposed to the Harmony. Yeah, costs too big a factor.
Would you ever own a gold stock?
Well, they haven't done anything in the last 5 years, so no.
Byron, hot or not?
Not. When you talk about innovation, I suppose one way they could innovate, and there have been talk about this, is mechanizing labor and, you know, hiring less people. But with over 90% of the assets in South Africa, we know how strict the labor laws are here. Any talk or any sort of push towards doing that is going to cause big trouble. So even in that, you know, field, they're struggling. Definitely not.
Simon, hot or not?
No.
No.
Not even. If you like gold, buy the ETF. If you want to buy a gold mine, go and buy a PanAf or
Yes.
Anglo Gold Ashanti, and buy Harmony.
Construction company Group 5 fell short of its market expectations with a 44% drop in full-year profit as it continues to struggle with an industry-wide slump. The country's fifth biggest builder said diluted headline earnings per share totaled 315 cents in the year to the end of June, compared with 561 cents a year earlier. The company said its construction order book totaled 8.8 billion rand, compared with 9.2 billion last year.
Market cap of 3.4 billion, price earnings 12.5, because I took the earnings after impairment. I thought that was fair, and that's a negative earnings, so it gives you a negative price earnings, and a dividend yield of 2.5. I mean, gold mining's tough. Construction's almost as tough as that, although perhaps we can see a better future. The thing that struck me, and I mean, I'm always trying to find some positives, something for my strengths column, the operating margin of 5.4% versus 7.7%, and that's not a bad operating margin, notwithstanding they're in a really, really tough space.
It's not bad, but again, it's construction sector, and we all know that they have terrible margins. But if you have a look at 7.7 down to 5.2, as a percentage, that's a big drop.
About a third.
Yeah. So what's happened is, because of the global sort of crisis, all the big players had to come back to the South African market, and that's squeezed margins locally. So the smaller guys like Group 5 have really struggled because of that, because now they're competing with the Wilson Baileys and the Murray and Roberts.
Okay, so let's take a look at the construction sector as a whole. When you look at the beginning of the year, a lot of people, contrarians out there, and of course I'm alluding to the likes of Simon, and of course I know the Cannon Asset Managers, management guys also quite enjoy the construction stocks. Is this the final bottom, or do you think that there is more pressure to come? Because when we see the rhetoric, the company says earnings pressure is going to remain into the financial year of 2012.
Yeah, and you know, I think it's very difficult to always call a bottom in stocks like this, but you've just got to ask yourself, you know, how much further can they go down? You know, it does look good, because they do say they're trying to diversify into Africa, which might do well for them. Also, you know, they haven't benefited because they haven't really got a lot of exposure to the private sector, and they said that they are going to try and build on that. So, you know, hopefully that can increase their numbers, and they can do well. But yeah, I mean, you know, I think over a long period, you know, if you buy the stocks like Group 5 Murray's, you know, you will make some money back.
Is it, Byron, as Oliver said, it's hard to predict, but is it a fair shot to say that probably the worst is behind us, but the best might be a long way off? I mean, the one comment they make is that 2012 starts with secured revenue equal to 81% of 2011, order book of 8.8, but notwithstanding the quote Delaney said, where the CEO is saying recovery anticipated from financial 2013.
Yeah, secured revenue, I mean, you have to consider that we've spoken about this before with government and their payments, so how secure is that, first of all? Secondly, I had a look at cement sales, and you sort of see a trend of things starting to pick up. And as we know, the market will start picking up before we actually see the data. And if we could all predict the bottom, we probably wouldn't be sitting here. We'd be sitting on the beach somewhere ready to retire. But I think you're going to need to be patient if you want to invest with these companies. But building will never go out of fashion, and the cycle will turn. We do know that government has a lot of money set aside towards infrastructure spend. So that is going to start filtering into the economy. Obviously, because of global weakness, government revenues have been slightly lower than anticipated. So they've had to cut down on their infrastructure spending. But at the end of the day, the cycle will turn, and we've still got a lot of people in this country that need to urbanize, and so there's a lot of potential off a low base still.
What's quite fascinating is that we've seen a lot of these companies saying they're actually taking some work on with zero margins. Tell us about whether we might just see some kind of consolidation within the industry going forward. If this is not the bottom, if we do see more pressure, and if government doesn't make good on that 800 billion rand that it's been threatening to spend, which we haven't really seen filtering through aggressively into the order books.
Yeah, I mean, I think just the fact that you've got to offer that 0% is quite a scary place to be. So yeah, I mean, let's see if they can. I really don't see that happening and them becoming profitable in any time soon.
Byron, they were very aggressive on write-downs, and it's what hit their earnings to a degree, about $500 million impairments, property, plant, equipment. I kind of like to see that, although I can't help thinking that maybe they're a little late in that. Last year perhaps would have been a good time. It's going to make next year's numbers look better because they won't have the massive impairments. Almost a sense of a little bit late to that party.
I don't know how their accounting practices work, but yeah, I mean, if you've got to write down your assets, you have to write down. There's nothing you can do about that. Again, like you said, it will make next year's results look better. I don't know, maybe they know something we don't. Maybe they're gearing towards a big year next year. They did mention that things were going to start looking better towards financial year 2013. But if you're a long-term investor and you're willing to buy and hold these things, they're still paying dividends. They're still paying you while you hold on to them a lot better than the gold stocks. That's for sure. So I would be happy to be going into that, but I'm patient and I feel like I've got time on my side.
And you're very young.
Okay, but I know you were mentioning cement sales, and I know that you're probably smiling and you're watching those numbers very closely because you're actually exposed to PPC, right?
Yes, we prefer PPC. I mean, it's broadly exposed to the whole market, and I suppose the biggest capture is their margins. 5% margins aren't great at all when you look at the construction stocks. The cement margins are so much better. It's a simple business. It's easy to make cement. It's easy to transport around the country. So when the construction sector picks up, PPC should be able to pick up.
You never run over budget. You never not get paid.
So Group 5, hot or not?
Go not.
Not
on
hot.
that basis, I like the construction sector. I think it's offering good value. But if I were to pick one of the construction companies, probably Wilson & Bailey, not
Group 5. Okay, and for you?
Mildly hot. I mean, I hear that they've got some Transnet has awarded them some tenders, 7.1 billion rand. So maybe going forward there might be an opportunity. I like things from a low base. You just don't know if they're going to get any more cheaper than what they are.
Okay, so you said mildly hot. So would you think about accumulating Group 5 shares?
Yeah, I'd think about accumulating them, put them at the bottom drawer and let's see what happens.
Okay, and you, Simon?
Look, I like the sector, and as Byron said, this is a long term. It's not going to make you rich in a hurry. But my preferred picks would be Vestact, which I've got a holding in, maybe Avenge. Group 5 would maybe be number 3 on my shopping list. I like the idea about PPC as well, which just gives you broad exposure, less particular operational risk.